Good afternoon, everybody. My name is Franco. So today I'm going to talk about the global financial crisis of 2008, and we're going to see what was the root cause of this systemic failure. Let's start by historical home prices, which they were increasing with a steady rate of 8% from 2000 to 2006. But in the meantime, the household income only increased by 4.5% yearly on average. And this caused for people to default on their mortgages. And the more defaults we had, the more houses went into foreclosure, and the number of houses on the market increased, which drove the prices down. And this thing causes people a hard time to refinance their loans, because people usually refinance when the prices are going up so they can get a better deal on their loan. This turns into a downward spiral that repeats itself, and it fuels the crisis. Some of the reason why it happened is the government deregulations, starting from Glass-Steagall Act, which was the act that separated investment banks from commercial banks. And now they repealed this act, and now the commercial banks can trade securities and the investment banks can start giving out loans. And the CFMA, the Commodity Futures Modernization Act, which deregulated all the derivatives. And also there were no value checks on any derivatives. And some of the complex products that were being sold during the time, the most important one is the mortgage-backed securities, which is simply a pool of mortgages which are different credit ratings. AAA is the best credit rating. It's people who are reliable to pay back their mortgages, people with good credit scores, with collateral, and B are the toxic loans. But this whole security was rated as a AAA, so that's why it has so much demand and people were buying it. And when things got worse is they took a group of mortgage-backed securities and they took the lowest tranche of each one and they created a new product, which is called a collateralized debt obligation, which only had toxic loans, where there were like more toxic loans, less toxic, and this diversity for some reason gave the rating agencies to give a AAA again, and this caused, this fueled even more the crisis. And people, the big banks, they noticed that people started defaulting. As people start defaulting, the big banks, they wanted to buy insurance against the default. So an insurance against default is called a credit default swap. The fact that the CFMA came into power, they could buy a swap, an insurance policy, even if you don't own the asset. So that's why the insurance market went into 60 trillion, which is 6 times the market of mortgages. And that caused solvency problems when they started defaulting. According to Andrew Law, an MIT professor, he said that the human behavior caused all of this because people were greedy in good times and fearful in bad times. And this is an unavoidable fact of capitalism. And Simon Johnson, also an MIT professor, he said it was because of oligarchy. Banks became too big to fail. And according to David Bain, a Columbia professor, he said it's not the banks, it's not the greediness, it's because people, an average person, they cannot pay their own debts. To conclude all of this, I would say we can't point a finger on any of these to say that one of these is the real one to blame. In this case, it's a combination of credit rating agencies who overrated the banks and the regulators, and also the homeowners who got mortgages even though they can't afford them. The key takeaway of all of this is that when risk gets hidden, it always comes back stronger. It's like a bubble that one day it will burst. Thank you everybody for your time.
You